Hello, hi everyone. Welcome to Momentum Lab, and I'm Shekhar. So, in this video, I'm going to talk about the market performances, the sectoral performances, and also how factors have performed. But apart from that, I also wanted to give an update on why did we stop sharing our portfolio performance. So, if you have observed our videos, we have refrained from talking about our portfolio, how is it performing, what is the rebalancing that we're doing, how is the strategy doing, and all. This is because of two things. One, there is a regulation or a circular published by SEBI back in January 2025 that apart from research analysts, no one else should publish a model portfolio. One. And second thing, even stock level discussion should not happen by the influencers. So we can give a broad level overview of the markets, but not talk in detail about stocks. So with that, we felt that it is not right to be on the wrong side of the law and refrain from doing these analysis. But of late, there has been another circular published recently in July, on July 23rd, to be precise. So, in that report, SEBI actually clarified a lot of things, which helps us again to put things in perspective and restart some of our discussions. Maybe not the model portfolio, but some of the discussions that we were doing earlier can be restarted again. So, let's take a look at what is SEBI saying. So, in the FAQ sections that SEBI has answered, there is one question called what are the communications excluded from the definition of research report? So, research report does not include the following communications, which is comments on general trends in the securities market, discussions on broad based indices, like what we do on market cap indices, sectoral indices, or factor indices, commentaries on economic, political, or market conditions. We usually refrain from doing any macro level stuff because we don't know anything about it. And also says statistical summaries of financial data of the companies. Yes, this is what precisely we do. We usually do statistical summary of all the of financial data as well as non-financial data in terms of technical data and other price-related information and present it. Then technical analysis related to demand and supply in a sector or the index. So we have been refraining to do this so far, the technical analysis part. Now we are free to do that. So having said that, so we still can't present the model portfolio. So that is a major reason why we're not discussing about what our portfolio is and how is it performing. That is one. Second thing that I also wanted to share is since we have started our business in the mutual fund distribution ship, we are more focused towards that business and we have reduced the amount of money that we do personally on our trading front or even in our investment front. Mostly, as I mentioned in my previous videos, also our investments predominantly the core portfolio is in investments in mutual fund. The satellite portfolios is what we run on the momentum side. But that momentum side also, we have again said that we are going to split some part in the momentum indices and some part in the momentum related stock portfolios. So it is very tiny bit, and that might eventually be running in its autopilot mode. Maybe if we get a partial RA or an RA license in future, then we'll be happy to present it again. So let's get back to the monthly analysis and see what's happening in the market so far. So if you guys remember, we used to usually show the market snapshot. The market snapshot is a quick glance or overview of how the different sectors or the market caps are doing. So we start at a global level, see how the Hang Seng Bees, which is the proxy for the Chinese market, how is the Nasdaq, a proxy for the US market, and then how is Nifty 50, the proxy for Indian market, and then the commodities like silver and gold are doing, along with the debt funds. So if you see in the last 1 year, the markets that have performed really well are the Chinese market, silver, gold, and to a certain extent, even Nasdaq. The last 1 year, Nifty 50 has been dull, flattish performance, two and a half. Even in the recent past of 6 months and 1 month, also there's no movement. It is a sideways kind of a market. Whereas the commodities like gold and silver have rallied a lot. Even the Hang Seng, which is the Chinese market. Now, if you take a double click and take a look at the market cap indices within the Indian universe, you see the same sluggish performance. The Nifty 50 being an exception of doing at least giving 2.5% returns in the last 1 year, whereas the next 50, Nifty Next 50 or the Junior Bs has given a negative performance and Nifty 200 1%, and Nifty 500 around 0.9%. So more or less we are the same as what we were in the month of August 2024. And of late, there's been some bit of movement in the last 1 year performance. And if you take the last 6 months performance, again, it is mm, slightly less than the T-bill rate performance of 4.5%. Now, if you take a look at the factors have taken a severe beating in the last 1 year, especially momentum and alpha. So where did I get this factor data? These factors are nothing but taken from the respective ETFs that are published and taken from the Google Finance. This is the 200 momentum 30 index. This is the 200 quality index. This is 200 value 30 index. This is Nifty 100 low vol 30. This is Nifty 200 alpha 30. I've not taken the large cap or the broader cap factor universe. I've only taken the large cap factor universe. And the factor which has stayed the calm since last 1 year has been low vol, as can be seen in its performance over last 1 year and 6 month and 1 month being in the negative, in the green territory. Now let's take a look at the sectors that are doing well. Of late, media, metal, they too started to do well, and even the PSU bank is doing well. Nifty MNC was also doing well in the last 1 month performance. But if you take a look at the last 1 year, Nifty Bank and Nifty Financial Services have done well. Even when the markets, broad level markets, have just given 2.5% returns, these two sectors, banks and financial services, have given close to 11 and 16.5%. Even the private bank also did well, 7.5%. But the PSU bank did not do well, and it has picked up only lately. There were quite sectors which did pretty bad, especially the energy, public sector enterprises, and then Nifty Media, even the Nifty IT or the Nifty FMCG, realty, commodities, they're all in the negative territories. So that is broadly about the performance of the global markets, the Indian markets, factors, and sectors. Now let's take a look at some of the interesting things that we have recently launched in our backtesting engine. So one thing that I wanted to show in our backtesting engine is that earlier we only used to have the market cap indices as well as the factor indices. Now we have included all indices, so you can take a look at the sectoral indices, the thematic indices, as well as the market cap indices like Nifty 500, Nifty 50, small cap, large cap, etc. So I'm going to show one interesting insight that I wanted to highlight, especially when you see that while we were showing this sectoral data, right? We saw the media and metal being strong outperformers in the last 1 month. So sometimes we might get some trading ideas like why don't we trade the media or metal or some indices which are showing up prominence of late. So this tool actually helps put things in good picture. Let's say if you were to take the metal as an index and compare it with the large cap to Nifty 200, or you can take Nifty 500 also for that matter. Doesn't matter. Let's take Nifty 500. So what I'm going to do is I'm going to compare these two and show how can we sieve through the sectors which are cyclical in nature and which are secular in nature. So the sectors which are cyclical in nature often are uh, avoided for long-term investing. Maybe they can be good for sectoral trade bets, but not for a compounding journey. Whereas there are some sectors which are really good in terms of providing secular kind of a growth. So in general, my perspective has been to avoid sectors and thematic indices. But if one were to look at within sectors, what kind of sectors to avoid, what kind of sectors to take a look. So this tool will actually give a very good perspective. Let me show how does it work. So you can take a sector of your choice and compare it against a broad level market cap index. So what I've done right now is I've taken Nifty Metal and I'm comparing it with Nifty 500. So the way that you can compare a sector is by seeing its NAV. So if you see the NAV, that itself will give you an idea whether it is a secularly growing index or a cyclical index. So you see that the range of this blue colored line, this is nothing but representing the Nifty Metal Index, is sideways. whereas the red color line, which is Nifty 500, is growing in a secular straight line. And if you see the performance in terms of drawdown wise, the characteristic of a cyclical sector is that it is mostly in drawdown or in the underwater plot. When you plot the underwater in the drawdown, you see that it is mostly in the negative territory for a longer period of time because it's a cyclical in nature. So it always moves in a particular price band, and when it moves in a particular price band, then most of the times it ends up being less than its all-time high. If it is less than its all-time high, obviously the drawdown would be counted. And you see the blue colored bar, the blue colored drawdown plot. This is something that which scares me. If let's say I'm stuck in such an investment, I would be scaring because most of the times it is in negative territory, and it gets very difficult to come out of this index unless you time the entry and the exit perfectly. So this is one way of analyzing an index by checking its NAV versus also seeing the underwater plot. And even think about someone who's stuck in this index. Let's say someone has invested in during the peaks of 2007, 2008, and he is stuck in this index till 2021 May. So almost around 14, 15 years, the market hasn't gone anywhere. Also, you can see the volatility in terms of its daily returns. So the blue colored one is represented by the metal index, and the red colored line is represented by the Nifty 500. You see the bars, actually the range is from minus 10% to 30%, whereas it is from minus 10 to 15%. And these are even broader strokes of daily returns volatility. Whereas in Nifty 500, you see much calmer daily strokes of volatility. And then you can also compare the volatility in general. So the blue colored line is Nifty metal. You see it is mostly above the red colored line, meaning it is more volatile than the benchmark indices. And then you also see the max drawdown days. It took 4,833 days to recover from the global financial crisis of 2008. Whereas Nifty 500 just took 2,270 days, even though it is large, but still half the time that it took from the Nifty metal. Then the final uh, confirmation is in the box plot. You see the range of the box plot for the Nifty metal. It is too wide, ranging from minus 25% to plus 75%. Whereas the Nifty 500 is much more leaner in terms of the range. So what does this indicate? This indicates in terms of 3-year, 5 and 7-year rolling returns that the probability of someone getting a return which is on an average 14% is, especially if it is in a 3-year rolling return, it is the same as the Nifty 500, but it comes with a huge range. So you can be absolutely wrong or you can be fantastically right. So this is the problem with investing in a sectoral indices, that the range of outcomes are too wide. Whereas in terms of the broad market cap indices, we are broadly correct, and the range also is fairly in a tolerable range. And as time progresses, let's say you give more time of 5 years or 7 years, the range contracts in the Nifty 500, whereas the range for the Nifty metal is still wide. In the 7-year rolling return period, the lower fence is from minus 10% to plus 25%. So even after 7 years holding a particular index like Nifty metal, you can still end up getting a negative return, whereas that is not the case in terms of the Nifty 500 index. And you see the rolling returns, the blue colored line has its own cyclicality. There are some days where it even goes below 0%, whereas the Nifty 500 mostly is above the 0% levels. And in terms of 5-year rolling return, it is always above the 0% returns. And in terms of 7-year rolling return, it is mostly above 10% rolling returns. Whereas even in 7-year rolling return also, you see that the metal index is below the 0% most of the days. So that's how you can look at different sectors and come to conclusion. Let me also show the media as a sector and show how it performs against the benchmarks. So there are quite a bit of sectors you can play around and check the results to yourself and make your own inferences. I also wanted to show how can you use this tool to make to understand a certain market level data which has happened for a definite duration. For example, let's say you are bothered or you're interested to see what has happened specifically, let's say from Jan 2018 till what do you call 2021. So you can just hover around these data points, and if you want to go back, you can always click on this auto scale. So you can, let's say you select this range. So when you select this particular range, you can analyze what has happened during this particular point of time. You can also see the underwater plot during this time frame, and during this time frame from starting from Feb 2018 till Jan 2022, you can see the media index has been mostly underwater. The Nifty 500 did better. So you can zoom in, zoom out, select your time frame of your choice and analyze and take a call. So it might especially be useful for someone who wanted to see in the recent performance, let's say how is their particular index or a stock perform in the last 1 year. You can select the last 1 year's performance and see and compare the drawdowns of different indices. That's how you can do. And even in terms of volatility also, you can zoom in and see what is the volatility happening in the recent past. Is it better or is it worse? So this is the performance of media index versus this is the performance of Nifty 500. You can see that there's a lot of volatility in the Nifty 500 or in the Nifty media sector as compared to the Nifty 500. So that way you can compare different sectors. Now going back to our market snapshot. So I also wanted to show a couple of interesting things that you can actually decipher by quickly glancing these grids. You don't have to actually necessarily go to uh, a trading view or a technical chart to analyze how is the market performing, how is the sector doing well, or which sector is going to emerge. You can actually, just by looking at this grids, you can take a look and get an understanding of which sectors to quickly double down. So, for example, if you see a sector which is deep red in terms of 1 year, and the recent 1 month or recent 6 month is not that great in green, it means these are the sectors which have undergone a severe correction in the last 1 year and still haven't recovered yet. So, what kind of sectors that I like really well are the sectors which are showing a very tightness in range in the last 1 year time frame, the last 6 months, and in the last 1 month. So, for example, let's take a look at auto, pharma, and then consumption. So, I'm going to take a look at these indices and show what I mean. Let's say auto, and then pharma, and then consumption. So, let's go to the trading view. I'm going to search pharma first. So, you see the chart of Nifty pharma. So the first data point that we saw is that in the last 1 year, it has given only 2.5 or 2.1% returns. So you can compare in the last 1 year, that is starting from August of 2024 till now, it has almost been flat. So 1 year flat, then 6 months if you see, it is 0.8%, meaning in the recent 6 months, it has given almost negligible returns. So we can take it from February of this year till now, again flat. And then we'll see the last 1 month. The last 1 month also, it is recently started to bounce up 2.5% return. So the 1 month is not 2.5%. Now, what does it indicate? If a sector is flat over the last 1 year, 6 month, and 1 month, it means that it is undergoing a base formation or undergoing a tight volatility contraction. So if you see in this 1 year time frame, it went above and it went below, but again it is still in that same range of what it has been in the last 1 year. So this particular sector has been undergoing a consolidation, as you can see in this base that is getting formed here. And if you take a bigger picture of on a monthly time frame, you see that the pharma sector has given a breakout in the month of August 2023 and has rallied, and since then again consolidating. So it is waiting for the next leg of up move, and in the last 1 year it has just been consolidating. So let's take a look at the next sector, which is CNX Auto or the Nifty Auto. Nifty Auto also, if you see in the last 1 year, from August 2024 till now, flat. But again, in between, there have been volatility. But now again, it has been subsumed. In the last 6 months, it is consolidating very tightly in this very narrow band of 24,000 levels to 23,240 levels. In this tight band, it is consolidating the auto sector. So this is something to again watch out for. And lastly, as I mentioned, is the Nifty consumption. The CNS consumption is also consolidating very tightly. If you observe, this is again weekly chart. Same pattern as pharma or auto that I just showed. In the last 1 year, it didn't move anywhere, but it had its own peak and trough in this 1 year itself. And in the last 6 months, it has consolidated. And in the last 1 month also, it is consolidating very tightly. If you actually broadly see, the Nifty 50 is also undergoing a similar pattern of consolidating. In the last 1 year, it didn't move anywhere. But within this 1 year, it was volatile. It went up, it went down, again consolidating. Now, if you see the broader picture, I wanted to show is that I'm referring to the weekly chart. The red colored and the orange colored line are 20 and 50 weekly moving average. 20 weekly moving average means 20 into 5, roughly 100-day moving average. 50 weekly average is nothing but 50 into 5, 250-day moving average. So the pattern that I usually observe is that whenever there is a consolidation, a first leg of consolidation that happens, usually follows up with another leg of consolidation. So how do you visualize this consolidation is by this base formation that had happened during the Russian-Ukraine crisis war, and then again it consolidated well, and then again went into a further level of consolidation before finally breaking out. If you see a parallel with the current setup, you can think of the current leg of base formation to be its first level of consolidation. And this red colored line and the yellow colored moving averages can play as a good supports for the next leg of consolidation to happen and then move forward. I guess this is still work in progress. It will still take easily a couple of months or easily by end of this year to consolidate and break out to these levels. But if you see another interesting aspect that I've observed is that especially with this 20 moving average and 50 weekly moving average, a sign of consolidation or bottoming out happens when there's a kiss or a touch that happens between the red colored line and the yellow colored line at these levels that we saw. And when this touch happens, and again the markets bounce back, and the second time when the consolidation happens, they don't touch or they don't kiss each other. They just stay, they come close, but they refrain, and then a breakout happens. Same thing I'm observing right now between these two moving averages. The red colored line as well as the yellow colored line have recently touched during the month of March and April. And then there is a rally. Needs to be seen whether this consolidation happens and do we see a touch happening or some kind of a petering out of the market happens and again we rally back. So there can be a lot of parallels that can be seen in the previous 2022 to 2023 rally to 2024 and 2025, what is happening right now. So this actually I've been seeing this data of previous months, also previous years like 2010, 2015, what has happened. So I found a similar pattern to emerge, and especially if it breaks down, then it is a severe breakdown. But if it is just a touch and go, that is a very good indicator of further up move to happen. So far, so good. There is no signs that it is going below the orange colored line, that is the blue, the red colored moving average is not going below the orange colored line. Everything is fine, but yeah, there's a pain that we are seeing in the last couple of months. But if you see in a broader picture, this is needed in terms of consolidating that needs to happen, because if you see the broader level things that are happening in the market, there is no stopping of the SIP money. The SIP money is pouring in very rapidly and briskly. The FIs have stopped a bit. The market's also not correcting deeply. They are just in a sideways market, even with elevated valuations. So it will take it some time to consolidate and move forward. So that's the broader picture that we are observing from Momentum Lab, and we'll keep you posted. Anything interesting that comes up, and do check out our backtesting engine. It is app.factorlab.in, and we'll also be adding RRG as I mentioned going forward, and a couple of other interesting backtesting tools. Uh, we'll also be adding. Thanks a lot, guys. Have a nice day. Bye.